Hello, everyone, and welcome to the Complete Wealth Management Podcast. I'm Dave Alison, and I have my colleague on the podcast with us today, David Roth. David, how you doing today?
I'm doing excellent. How are you doing, Dave?
Awesome. I appreciate you being here today. The whole goal at Alison Wealth Management is helping high net worth families explore and implement strategies for better wealth outcomes. And we have so many clients that have accumulated wealth via stock options, whether it's incentive stock options, equity grants, restricted stock units, non-qualified stock options, enough to make our heads spin with the complexity that surrounded this. So we wanted to do this episode just talking about kind of looking back over the last decade or so of helping clients navigate or at least educate them on some of the decisions that go along with getting stock options or equity grants. And so, David, excited to have you joining me today because I know at least for the last 3 years since you joined Alison Wealth, you've been instrumental at diving into the analytics of understanding and helping our clients understand their stock options and forecasting and modeling and looking at tax implications. Excited for you to kind of share some ideas, insights, best practices, and things that we've seen happen with other clients.
Yeah, I'm excited to be here. And I'm excited just to talk more about stock options. I'm one of those interesting people who loves this. I love tax. I love stock options. But I actually wanted to ask you a question, which is going back to how you got into stock options and just the background of how this all started. If you wouldn't mind sharing a little bit about that.
Yeah, definitely. And I mean, that was kind of the genesis of Alison Wealth Management opening up its office out in the heart of Silicon Valley in Palo Alto. David, my brother, had a tech company in New York City. He was a founder and chief technology officer for the company. And they were acquired by, at the time, Facebook. And so it was a kind of pre-IPO stock deal, like so many are. And so I was forced into it from a tax, investment, financial advisor perspective, trying to help him understand and navigate what this equity compensation meant. As I think looking back now, we all are aware, Facebook ended up going public in 2012. They had really structured their equity grants at the time with restricted stock units. They were actually one of the first on the scene with kind of a double vesting that was not only time-based, but event-based. And that event-based was that IPO. So a lot to think through. And, if you kind of rewind all the way back to 2012, their IPO didn't go so smoothly. There was a lot of things that kind of happened there. And so from that time period, obviously we went into this era of the technology boom that existed from pretty much 2010 through 2020. You could argue it's definitely still going on today. And, I remember talking with my brother and him just sharing that so many employees at these tech companies were getting granted all of this equity and they just needed help making heads or tails of it, what their options were, liquidity, income taxes, strategies and ideas around the concentrated wealth that they had once these companies would IPO. And so that was really the genesis for us of doubling down and really focus on being one of the industry's top advisors when it comes to equity compensation, just being able to plug into that demographic and that market and really in the tech space in Silicon Valley. But what's ended up happening, and you're well aware of this now, I think over the last 10, 12 years, so many other big companies have seen this playbook that equity compensation really does incentivize employees to really take an ownership mindset in the company that they're working at. And so many companies, even outside of Silicon Valley, are now utilizing equity compensation. You're in the Boston area, and there's a ton of pharmaceutical and healthcare companies that are now utilizing, whether it's incentive stock options or restricted stock units, performance stock to really incentivize and inspire their employees to build great companies. And we've just seen that our business at Alison Wealth Management has boomed. Our clientele have obviously accumulated a substantial amount of wealth in company stock, and they just need a trusted advisor who understands not only the financial, but the investment and the tax ramifications. And I think that's one of the things that differentiates us is.
Yeah. And you were talking about when you first started getting into this in 2011 versus now. Have you seen that companies are offering more grants now than they were back then? Or do you feel like there's more of an understanding of that? Or what's your take on both what the companies are offering and what you think the employees understand of these options?
Well, I think that if you're in particularly the tech industry, getting equity grants isn't a new thing anymore. Like most of the time, especially even some of our clients, David, I could think back to, they might be on their fourth or fifth go around with a company where
Mhm.
they've gotten equity grants. And what we've typically seen is companies and people, employees have gotten a little bit more sophisticated in terms of the grant. Obviously, if you go to work at a startup, there's a lot of risk in going to work at the startup. You're probably going to sacrifice base pay and salary and benefits. And so they need to give you a bigger tranche of early equity to really incentivize you to take that risk and join that startup. Whereas if you join a big mature company, Google, Apple, Meta, Amazon, Microsoft, you're probably at this point, unless you're a executive there, not going to have life transformational kind of wealth because of your stock. It's just going to be a good part of your overall base and total compensation package. And so I think that the same fundamentals, early stage companies are still incentivizing employees with bigger grants. It typically is incentive stock options. But then
Mhm.
as you get into maturing companies, specifically after they IPO, they start tending to use restricted stock units now. And I remember, I think it was Bill Gates that actually said this. He said, somebody who's granted incentive stock either can not afford a house or they can afford four houses. Because that's the thing with these stock options is you either are going to probably hit it really big if you start early enough at a high accelerating growth company, or quite frankly, they're just going to be worthless and never really turn into anything. And we all know the success rates of businesses out there. It's not every business that can turn to a unicorn and then successfully go through an IPO and bring liquidity. And so we'll talk a little bit about that today, but I think it's definitely matured, but there's massive fortunes to be made out there. Just yesterday, I was brought in by another advisor who had a client that had a substantial amount of money in NVIDIA. They were an employee there. They had been granting stock options all along the way. This client doubled down and never sold any of his company stock when he was there. And what's NVIDIA up to 300% this year alone? And so, it historically he had done well, but it was this recognition event of NVIDIA becoming this market leader in AI that propelled that stock. And now this person has a quite substantial amount of money in that concentrated position, which brings another set of challenges and opportunities. And so it's always an evolving landscape, which is why it makes it so exciting. I think the big thing when we look at stock options and concentrated equity is if you have concentrated positions, it's generally like a badge of honor. It means you've worked at a company and it's actually succeeded. And so we help our clients navigate those concentrated positions on the back end once you do hit that home run or grand slam. But as we all know, unfortunately, business is hard and many of them strike out and they never turn to anything.
Yeah, absolutely. And just going back to that concentrated position, I think owning a concentrated position of stock in and of itself is going to swing the balance of your net worth one way or another. But adding the options, it gives you additional leverage. And those two things combined, huge swings in net worth and your value based on how your company's doing.
Yeah, you're exactly right with the stock options. And that's a good prelude, I think, into just giving a quick overview on the different types of stock options. Because, of course, with a stock option itself, there's this important component of leverage, right? And so if you think about what a stock option is, it gives you the right, but not the obligation to buy your company stock at a predetermined price at some point in the future. And so a simple example is if I have a stock option in ABC company and it gives me the right to buy that stock option at $1 per share, hopefully in the future, that stock is trading at a price somewhere above $1 per share. So let's say that stock is done well and it's trading at $10 per share, and I have the right to be able to go buy it at one. Technically, I could buy it at one and immediately sell it and recognize $9 of gain. And that is the intrinsic value of the stock option. It's the difference from what it's trading at today versus what your right to buy it is. In that simple example, you have an intrinsic value of $9 a share. Now, David, you brought up a great point of leverage, because anytime you apply leverage to a financial investment, you could greatly compound your returns, but it adds even more risk. And so with a stock option, you don't actually have to go outlay that dollar to buy the share. The company is essentially giving you an interest-free loan because they're granting you that option to buy it at some point in the future. And there's a time value of money component to that, because again, let's say I have 100,000 stock options that give me the right to buy the stock at $1 per share. If I want to go execute that right and buy the stock option so that I now am a shareholder of that company, I would have to come out of pocket $100,000 of my own money to execute and exercise turning that option into an actual share. And there's some very good reasons we'll talk about in this podcast on why somebody might want to do that. But that's a financial decision because, quite frankly, maybe you don't have the $100,000 liquid to do that. Or maybe that $100,000 is invested in something else. And if you sold that other investment, you're going to have an opportunity cost of what that other investment might have earned. And so these are all the things that we talk to clients all day long about. But David, let's talk about stock options for a minute before we get into restricted stock units and performance stock. But on stock options, there's two types. Tell us about the two types of stock options that exist.
Yeah, so there's essentially two types. One would be the incentive stock options, and the other would be non-qualified stock options. And the difference between the incentive and the non-qualified stock options is that incentive stock options may have favorable tax treatment, whereas a non-qualified is going to have just ordinary tax treatment to that. So those are the two main categories, but you can break it down even further, because within the non-qualified stock options, you could have different types, such as RSUs, restricted stock units, or you could just have grants where you get the right to purchase stock at a future time for a future value, like you stated. So those are the two main types: the incentive stock and then also the non-qualified stock.
Yeah, definitely. And so incentive stock, just like the name, there's essentially a tax incentive to be able to own that stock if you exercise and you follow some pre-described rules. And so with incentive stock options, essentially, if you exercise that option, now you own the shares of the company themselves. And if you meet a certain holding period requirement, you could actually achieve a more preferential tax upon the sale of that stock. And so with incentive stock options, there's something called a qualifying distribution and a disqualifying. And so again, with a qualifying disposition, you are eligible for a more tax advantageous rate when you go to sell that stock. Whereas a disqualifying disposition, you're just going to be taxed as if it's ordinary income. And so the thing to think about with your incentive stock is, from a tax perspective, you really want to try to achieve that qualifying disposition status. To do that, you need to sell the stock at least 2 years after it was granted to you, and at least 1 year after you exercise it. And so let's take a scenario where you go to work for ABC company and they grant you 100,000 stock options in 2018. And in 2020, you decide you are going to exercise these stock options, which means you're going to turn over a sum of cash to the company to exercise the options and now own the actual stock itself. So that happens in 2020. Now, if you sell that stock anytime in the preceding 12 months, so anytime 12 months post exercise, it's what's called a disqualifying disposition, and you do not receive the favorable tax treatment. In that case, any gain from the price you paid on the stock, which is your exercise price, to the price you sold it for would be taxed at ordinary income rates. And so let's say you pay $1 per share to exercise the stock, and now it's worth $2 per share, and you had 100,000 shares, you have a gain of $100,000 because you paid $1 and you sold it for $2. So that's $1 per share or $100,000 gain. If it's a disqualifying disposition, that's taxed as ordinary income, which is the typical tax brackets that we all know: 12%, 10%, 12%, 22, 24, 32, 35, or 37%. So let's say you're in the highest tax bracket. That's 37%. Essentially, on that $100,000 of ordinary income, you'd pay that 37% tax. Now, if we achieved that qualifying disposition status, meaning that we held on to these options and shares at least 2 years from the time they were granted and greater than 1 year from the time you exercised. So let's say we exercised in 2020 and now it's 2023 and we go to cash in some of those shares. At that time, it is going to be taxed at a more preferential long-term capital gain tax rate. And so instead of paying that 37% ordinary income rate, the top long-term capital gain tax rate is 20%. And then in today's tax environment, there's an additional 3.8% net investment income tax. So the top federal rate would be about 23.8%. And so you can clearly see, if you're in a high income bracket, paying 23.8% on your gain is a lot better than paying 37% on your gain. But there's some trade-offs to get there. Number one is you have to actually exercise that incentive stock. You have to come out of pocket and buy those shares. And then number two, you have to meet the holding period requirements. So you have to hold on to that investment. You can't cash it in. So you have to have some money on the sidelines to be able to buy the shares in the first place. And then you have to meet the holding period. But there's a third big kicker on incentive stock exercises, isn't there, David? It's the one our clients hate the most.
It's the reason why you might not exercise, because Dave, you might be able to answer this, but what would happen if you have a stock ABC company that's worth $1 per share, but now the value is $100 for that, so there's a $99 gain on it? And is there a reason you wouldn't just exercise them all right now?
I would say if you have the option to buy a stock at $1 and it's worth $100, number one, you're probably pretty happy because you hit a home run. But you might pay more tax than otherwise you would have if you did exercise. And what David's alluding to with incentive stock options is the alternative minimum tax. And so the alternative minimum tax is like a parallel tax system that most people are never subject to, but those who have incentive stock options are subject to this. And so if that was the case, and I have a stock option in which I could buy the stock for $1 per share, but it has a fair market value of $100 per share, I have a $99 intrinsic value on each one of those options. Now, if I exercise those options, and let's say I had 100,000 options in my example earlier, we would essentially have to report $99 per share of alternative minimum taxable income on your tax return. Think about that, $99 per share times 100,000 shares is a lot of alternative minimum taxable income. What this essentially means is you, in that situation, more than likely would be assessed income tax on this phantom income because you haven't sold the stock yet. You don't have the cash proceeds from selling the stock. But the IRS says, yeah, but this had an intrinsic value to it, and we're going to tax you on that. So you end up paying an alternative minimum tax. And we're not going to get deep into AMT because, quite frankly, it would take 5 shows for us to do that and everybody would fall asleep. That's what David and I crunched the numbers behind the scenes to show you the optimal amounts that you should be thinking about exercising without making it so unaffordable that you push yourself into a massive alternative minimum taxable liability. But the one thing with the AMT is it's very much like prepaying future tax. You're going to get a minimum tax credit for the amount of AMT that you pay, and you're going to be able to recoup that in future years. It just might take you 2 years, 5 years, 10 years, 20 years to be able to recoup that tax credit that's going to carry forward. And so there's a couple things that we see. If you're very bullish that your company is going to continue to just skyrocket in valuation, it might very well make sense to bite the bullet, exercise everything, pay the exercise cost, pay all the AMT, because you're going to save a ton of tax long term. And we've had some companies that have done that. We went through the Snowflake IPO, and that was historic. We had clients that had stock options in the 20 to 50 cent range. And that company IPO'd for, I think, $250 to $350 per share. I can't quite remember. We've had other companies where, again, the clients were very bullish on the future of the company and they were willing to come out of pocket for the alternative minimum tax and the exercise cost. But that's a financial decision. You need to weigh the pros and the cons of, does it fit into your financial plan? Is it worth the risk for the ultimate reward? What is the tax savings? And something that we look at frequently is, what's the hurdle rate? Like, how much does the company's stock have to appreciate in order for the tax savings to really materialize versus the out-of-pocket expense? So I know, David, like, you've built some awesome models. I've seen you present them to our clients before that show, like, here's if you exercise 5,000 shares or 10,000 shares or 20,000 shares. Talk about a little bit like how you design those and how you help clients think about an optimal amount they should exercise in any given year.
Yeah, that's a good question. And I feel like there's two parts to it. And again, the hard part is simplifying it, which because the AMT and tax system, it's anything but simple. But really, if you want to take it into the simplistic form, there's a certain amount of AMTI, alternative minimum taxable income, you could create every year without paying any additional tax. For most people, it's somewhere between 30,000 and maybe 100,000. And so the first thing that we want to do is figure out how many options you could exercise with and purchase them, but not pay any additional tax. So that's step one into thinking.
That's what I always joke and refer to as the sweet spot, right? That's the no-brainer. If you think your company value is going up, you at least want to do that every single year, because that's kind of use it or lose it. It's a bit of a freebie in the IRS tax code when it comes to AMTI. The only out-of-pocket money is, of course, the cost of exercising.
Exactly. And then beyond that, we can model out how much gain or how much value do you get from a tax perspective from exercising now versus exercising later. And again, the trade-off is that if you exercise now, you might pay additional tax, prepay it, but you're going to recoup that with your AMT tax credit. Some of the models, what we'll do is we'll take different tranches and say, what if we exercise 25% of them, 50%, 75%, 100% of them this year, and to see what that would look like from a tax perspective. And sometimes if a client's really bullish, they might go for it. Another key part of this decision too is, and this is something we might talk about more later, is your timeline with the company. Because one of the trade-offs with having these options is you don't get to keep them if you leave the company. You have usually 3 months when you leave them. Another common scenario that we have is that a client is with a company and they're either considering an exit or they already have determined to take an exit. And then it's a question of what makes the most sense in terms of exercising, of keeping this, can we do it within 2 different tax years? So that's another option, is if you think you're going to be working at a company for 10 years, your exercise schedule is going to look a lot different than if you plan on moving on after the next 3 or 4 years.
Yeah, David, that just came up with the client I was chatting with. It didn't financially make sense for them from a tax perspective to exercise because their strike price on the options were so high that they just didn't have the liquidity to do it. But they weren't going to be working for the company for more than 2 years. And we knew that they'd continue to defer those options. But to your point, when they quit working at the company, they're going to have to exercise them all. And so what we did was we did what's called a cashless exercise, where they exercise some of the shares, but then they sell just enough to cover all the cost out of pocket to exercise. And we did that where we did some this year in 2023. We're going to do another tranche in 2024. And then we'll have that final tranche in 2025, which is the year they plan on quitting that company and going to work for another company. But that allowed us to spread out some of that impact over 3 years. And so those are all things to think about in terms of incentive stock options.
Yeah.
So let's close the book on incentive stock. We could do a whole show on that. And there's so much intricacy into incentive stock. It can be quite complex, but I think just the bow on it is the worst thing that I see employees do with incentive stock is nothing. They sit on it and they don't do any strategic planning, and they miss these little opportunities. Even if we can get you to a point where you exercise 500 or 1,000 shares without paying any AMTI, that's additional tax savings down the road at some point once you go to sell those. And the other big mistake is they work with a tax professional or they do their own taxes that isn't an expert in incentive stock. So, that's a big reason, David. I know we do our clients' tax preparation at Alison Wealth Management, is there's so much tracking. If you have incentive stock, you have to track your cost basis in the stock. You have to track a separate cost basis, which is your alternative minimum tax cost basis. You have to track your minimum tax credit carry forward each year. And if you miss any of those things from a tracking perspective, you could end up paying tax twice on the same amount of money. So it's just critical from not only a compliance, but a strategy side of things to be working with a team that really knows what they're doing when it comes to incentive stock options.
Yeah, and one more thing I'd add is even the companies themselves sometimes misreport them. I think we caught a handful of errors where we had to get a pay stub or a 3921 corrected because the company himself didn't report the stock. So we had it planned out. We were expecting what the tax would be, and it was different. And we had to go back to the company and say, you have to fix this. So that's always an interesting conversation.
Yeah, absolutely. Let's jump into the latter two, because quite frankly, the other two are quite a bit more simple. So if you don't have incentive stock, you probably have non-qualified stock options, and NSOs are where there's not that tax incentive to exercise early. So, the only reason you would exercise early is if you think that company is just going to massively accelerate in value. Because with a non-qualified stock option, when you exercise, you are actually going to pay ordinary income tax on that intrinsic value. So again, if I have a non-qualified stock option with a $1 strike price, and it's now got a fair market value of $10, there's a $9 intrinsic value. If you exercise that, you're going to report $9 of ordinary income at the time you exercise, even if you don't sell that stock. That's different than an incentive stock. You don't report ordinary income at the time you exercise an incentive stock option, only alternative minimum taxable income. But again, if you think that company stock is going to greatly accelerate in value, it might make sense to exercise early. Or if the fair market value is right around your exercise price, it might make sense to exercise early because you're not going to have much intrinsic value. And then assuming that you hold that stock for over a year, any future sales are going to be long-term capital gain. There's even elections that we make for some of our clients called an 83B election when it comes to stock options. And that's where we opt into exercising early. In some cases, exercising even stock options you have that have not yet vested. So there's forfeiture risk there. And there's some things that if that applies to you, we want to talk through and educate you on the trade-offs of that. But it's essentially saying, hey, I was granted all these stock options. The fair market value is right near the strike price, so they don't have much intrinsic value. And even though I'm not vested in all of these options, I'm going to opt into the IRS to basically declare that I'm exercising all of these and pay any tax due today. Now, you have a certain time limit to file that 83B election. And so you have to make that decision very quickly when you're granted these shares. That's why David and I always tell all of our clients, if you ever get a new equity grant, we need to be like the first people that know, because there are some time constraints to this. But for the majority of our non-qualified stock option clients, we're pretty much just deferring. We're tapping into that leverage, right? Not having to buy and exercise the shares, particularly if the exercise cost is high or if there's already a lot of intrinsic value in those shares, because quite frankly, a lot of people just can't bite the bullet and pay all that tax on the shares, particularly if there's not a secondary market and those shares aren't liquid, meaning you can't sell them. And so again, we typically see that with our traditional non-qualified stock options. Anything else on NSOs, David, before we flip the script to RSUs?
Yeah, I think that's a good summary of it. So I want to talk about RSUs and see what there is to know there.
Yeah, definitely. So, in RSU, these are really simple. I'm glad the industry moved to these for the consumer standpoint, because there's not a lot to screw up or make irrevocable decisions in RSUs. The easiest way I could describe an RSU is if your company gave you a bonus in cash and you took that cash and you bought shares in your company, that's essentially what an RSU is. But the company is automating that process. And so upon signing up for the company, they might grant you $1 million of restricted stock units at today's share price, and it's going to vest over a 4-year period, let's say 25% per year. And so at the time that vest occurs, you pay income tax because now you own those shares, they settle. And so let's say that you're granted 100,000 shares or RSUs, and it's a 25% vest. And so the first year you have 25,000 RSUs that settle into shares. The first thing to note is that most companies do what's called a surrender of share to help pay for your income tax liability. And so the typical statutory withholding rates on RSUs is what, around 22%, right, David?
22%, but if you're over $1 million of RSU, they bump it up to 37%.
37. So let's imagine you're not over $1 million for the first take, and they withhold 22%. So they're going to essentially sell about 22% of the shares for federal tax. And then if you're in a state, most of our clients are in California, there's a California withholding as well. And so the net shares are going to settle into your stock account, whether that's at Schwab or E-Trade or wherever the company has aligned to hold those shares. So if you had 10,000 shares that vested and they're withholding 22% federal and let's say 10% for state of California, that's 32%. Essentially, you are going to have 68% settle into your account, or 6,800 shares. Those are yours now. The day those go into your account, you could either make a decision to hold them or you could sell them immediately. If you sell them immediately, you don't owe any more income tax because the day that they vest, you establish a new cost basis in that stock. And if you sold them immediately, you're going to sell for about the same price that your cost basis is. But if they vest and then you decide to hold them and the stock price goes up and 6 months later you decide to sell, you would have a capital gain. The capital gain would be the difference of the market value on the day you sell minus the cost basis, which was established the day that stock vests. Again, if it's sold within a year of vesting, it's a short-term capital gain, taxed as ordinary income. If it's sold after a year from vesting, it's a long-term capital gain, taxed at a more preferential rate. And so when we look at RSUs with our clients, it really comes down to what's your expectation of the company. You know, you have your salary and your livelihood locked up in this company succeeding. Do you want to continue to accumulate concentrated wealth by holding on to your RSUs once they vest? And we have some clients that do that. They just double down and they go all in on their company. And our clients who worked at Apple or Meta 10 years ago, that certainly has paid off for them. But we all know not every company has future performance like Apple or Meta did 10 years ago. You know, and so the other option is when your RSUs vest, you sell them, and that gives you capital to be able to go use for lifestyle or to reinvest in other areas and diversify your wealth. And David and I always joke, it's the corny financial advisor line that you get rich on concentration and you stay rich on diversification. And so we help our clients navigate what percentage of their total portfolio is concentrated. And David, like if you were to look at a client's portfolio today, what percentage of their net worth or assets would have to be in one company before you would start to say that they start facing some concentration risk? I mean, do you have some general guidelines there?
For me, I have the 10%, where if it's more than 10%, you should start to have a conversation, because then that's going to have a substantial impact. However, what we do see is that our clients who have these stock options, RSUs, they might have more. They might have 50 to 60% or more of their wealth in this company. I think 10% or more is where you really want to have a deeper conversation, but you want to figure out what they're comfortable with and what that would mean to have that concentration.
Yeah, especially if, you know, and with David, you know, we have clients that have 80, 90% of their net worth in one company stock. And the question that we always ask is, if you've accumulated an amount of wealth right now that could allow you to achieve all of your financial goals and objectives in life, is that concentration risk still worth it? Because as we know, a company could go down. It could go out of business. It could go to zero. We saw that in 2022. Think about how many clients we had that had concentrated wealth. And in 2022, their net worth was cut down by 60, 70, 80%. And many of those companies have yet to recover. Who knows if they'll ever reach those 2022 valuations that they saw. And so it's all about risk management at that point on a concentrated position. And David, why don't you and I'll do another show on concentrated wealth, because there's a lot of ways to manage concentrated positions. But that's the guideline that somebody should be thinking about, is at what level do we want to keep building concentration, or do we want to start detracting from this concentration? The easiest way to detract from the concentration is to sell your RSUs when they vest. and then don't take those proceeds and reinvest. Like one of the mistakes that I see people make in some cases, particularly with big tech companies that comprise so much of the indexes today, is that they'll sell their Apple stock and then they'll go put money in the NASDAQ index. And that's okay. But at the end of the day, what does Apple make up? 10, 15% of the NASDAQ index right now. And so it's like they're selling the stock just to buy more. And so we need to be prudent on how we think about redeploying that capital so that we're not having overlap in the portfolio and buying more of the same position we're trying to get out of from a concentration standpoint. The other thing with RSUs and really any stock option is you need to be prudent on your company's trading policy. So we have a lot of our clients are deemed insiders, they're executives. They cannot just trade out of their RSUs or ISOs or NSOs at any time they want. They have to follow their pre-clear procedures. We have many executives where we implement 12b5-1 insider trading plans that just automatically sell some of their company stock each and every month. And we've got a lot of unique strategies and techniques on how we think about those types of plans, how we have plans run overlap to each other, when a plan would expire or terminate, and when we would want a new plan to start based on the client's financial goals and objectives. And so, again, a lot to think about when it comes to RSOs, ISOs, NSOs. David, in kind of landing the plane here on stock options, any kind of last words of wisdom or parting advice for anyone listening to the show today?
Yeah, I think the key is just to speak with somebody who knows what they're doing. Because again, the biggest mistake that I see is doing nothing or just leaving it sitting and just not making an informed decision. So I would say talk to somebody who has an understanding about this and figure out what your strategy is and make sure you're comfortable with that. Any additional thoughts on your end, Dave?
I will say two things. Number one, fortunes could be made or lost with stock and stock options and really equity compensation in general. It's why we've specialized in this area, helping employees and business owners navigate this. Look at the dot-com bubble, look at the amount of companies that raise capital and then go out of business. So there's just a lot of strategic planning. Again, to your point, work with a team of experts. And I want to close it out with a joke. David, why did the stock option go to therapy?
Why?
Because it had too many issues with vested interests.
Like that one.
All right, we'll end it with that. If you have any questions on your stock options, please don't hesitate. Reach out to our team. David's contact info will be in the show notes. My contact info is in there. We do this stuff all day long at Alison Wealth. We're here to help high net worth families explore and implement better strategies for better wealth outcomes. Appreciate your time, David. We'll see you on the next one.
Thanks for having me.
Financial planning and advisory services are offered through Prosperity Capital Advisor, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. Alison Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through Alison Wealth Management are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.